But regardless, whether that market is 80 billion or 160 billion, we're 1 billion today, and I see a pretty clear path to go from 1 billion to 5 billion without having to change.
Okay, so episode 35 of the Deal Ranch podcast. We have Brannen Edge. Brannen, you are CEO of Flagship Healthcare Properties. We're here in your office in Charlotte, which is very, very nice. Thanks for having me here. So I'll give a little overview for the show before you kind of dive in. So full-service commercial real estate firm focused on clinical outpatient healthcare, and you can dive into the nuances of the properties you guys own. But in general, you manage 300 plus properties, but then there's a REIT component which owns 100 plus properties, somewhere around $1 billion in market value, and then in total management somewhere around 6.5 million square feet. So you guys are quite a beast from Maryland down to Florida. But that's the overview, but I'm really excited to hear about this. This is different for the show to dive into the healthcare space, but would love to hear a little intro on yourself if you want to kick it off.
Sure, Matthew, thanks for being here, and thanks for the opportunity to share a little bit about Flagship Healthcare. Healthcare real estate was something new to me when I started, which is now going on 17 years ago this week, joining predecessor firm to Flagship. I describe myself as a recovering banker. So spent the first 6 years of my career doing commercial banking for what was then BB&T, and it was a great foundation for learning how to sell and how to underwrite companies and how to interact with prospective clients. A great education for me and great experience and a great firm to do that with. But after about 5 or 6 years, I said, I don't think I want to be a banker the next 30 years or so. And about a third of my clients at the bank were involved in real estate to some degree, whether they were manufacturing companies or real estate developers or service companies. And they looked like they were having more fun than I was having, and said, I want to try to figure out how to make that move. And so went back to Keenan Flagler at Chapel Hill for business school, studied finance and in real estate, and that's when I made the transition and joined what was the predecessor firm to what's now Flagship Healthcare Properties.
Wow. And we can trickle through your path right after school in kind of the predecessor of Flagship, but in your own words, what would be the best kind of high-level overview of Flagship in its current state? I hit on a couple maybe of the numbers, but what would be more of the details around the types of properties you guys manage and service, and maybe give a service overview too, because it's more than just property management.
Sure, absolutely. So we are Flagship Healthcare Properties is a vertically integrated commercial real estate firm focused on the clinical outpatient sector, and more specifically, that sector primarily in the southeast and southern United States. So that's a mouthful. What does that mean?
That's right. That's
clinical outpatient. So what that means is that Flagship wants to provide extraordinary stewardship and outcomes for all those companies and clients we gratefully serve in the outpatient healthcare sector. And so outpatient healthcare is just those facilities where a healthcare provider delivers care to a patient and there's not an overnight stay component. So it's sometimes easiest to think, what are we not involved in as opposed to what we are involved in? And those would be things like senior housing. We don't do that. We're not servicing those clients that are providing an overnight stay, or acute care hospitals where you come into the hospital and you're staying there for 2 or 3 days. We are focused, our bread and butter, if you will, are medical office buildings and ambulatory surgery centers. So 30 years ago, if you had a knee surgery or tonsil surgery, you'd go into the hospital and you'd be there for a couple days. I had my meniscus surgery about 18 months ago. I was in the same-day surgery center at 7 a.m., and by 2 o'clock in the afternoon, I'm home resting and preparing to rehab. So it's those kind of facilities that we're focused on. Mm-hmm. And we made the decision back in 2010 when we brought the two legacy companies together to form Flagship Healthcare Properties that how we were going to compete was by being vertically integrated. And by vertically integrated in this context, I mean we not only have to make good investment decisions for our capital and our investors' capital, but how we're going to compete is by having the relationships and the expertise in the markets in which we operate. So we've got 109 professionals who work alongside me at Flagship, and they are the best of the best. We've got asset managers who are tasked with thinking like an owner in terms of management decisions for a property, whether or not we own it or not. Mm-hmm. We've got property managers who are out making sure the tenants are taken care of in these facilities, that are managing not only the vendors who are servicing the properties, the landscaping team, the janitorial team, the trash, everything, soup to nuts. We've got maintenance engineers who are driving around town in Flagship branded trucks, taking care of the buildings to make sure they're up to snuff. We've got ground-up development teams that are out there working with healthcare systems and independent physician groups to help answer their needs. We've got leasing and brokerage teams that are working with those users who need space, whether it's existing space and helping them negotiate rents, or it's they need to find a new location. And our goal is that we think we can better compete and deliver better service to our clients if we have the relationships both with our investors and our tenants. And the expression that if the only tool you have is a hammer, everything looks like a nail.
That's right.
We want to be the exact opposite. We want to be the Swiss Army knife. And so if our client, if our whether it's a healthcare system or a real estate investor says, look, I don't want to sell you my property, Flagship, that's fine. How can we help them meet their goals? Right. And maybe that's through capital, or maybe it's through management, or maybe it's through evaluating their real estate strategy.
And it's got to be wildly valuable over time for all of the compound tribal knowledge you build from doing brokerage and leasing in-house, and then obviously asset management, property management, and then owning the properties. It seems like there's some basis points of value of knowledge in being able to communicate quickly, obviously, across all of those different types too. So going back into do you want to talk about the formation of kind of Bracket and then Flagship? Because I think the story is really neat from what I read online, but then I think it also tells your story of your growth from intern to now CEO, which is a crazy story. So you finished school, and maybe you can parlay this into maybe the original Bracket days somewhere in the 80s, but kind of where was Flagship and what was Flagship when you started here?
Sure. So I was in the first year of business school in Chapel Hill, and again, had just come out of the banking world. And as I was trying to figure out exactly what it is I wanted to do, I had loved my time at the bank and learned a bunch, and it was a great organization. But when I started thinking about next steps, really it came down to a lot of the opposites of what I'd just experienced in my banking career. That bank was formed in 1872, so very, very old. And I said, I want to go work for a young company. And that bank at the time had 20,000 plus employees. And I said, I want to work for a smaller company that's maybe a little more nimble. That bank was publicly traded. Mm-hmm. And I said, I want to go work for a private company. And I was as a banker, I was a broker of funds, advice also, but primarily of funds. I was loaning money to clients and collecting deposits, and I was the middleman. And I said, I want to find out how to be a principal as opposed to a broker. And so, at about that time, in the mid 2000s, when I was in school, one of the predecessor to firms to what is now Flagship was a company called Flagship Capital, and Flagship Capital had just been launched by my longtime partner, Charles Campbell, and it was really an investment firm, real estate investment firm, serving the needs of family office and high net worth individual investors. It had just launched during that year, and I called him up out of the blue and said, "You don't know me from anybody, but let me come work for you this summer as an intern." And
How do you take that call?
I think he was shocked more than anything. And we had several conversations over the next few months, and lo and behold, I became intern number one in between my first and second year of business school, and then ended up joining the company after graduating full time, and that was, I think I was employee number 6 or something like that. It was still very, very small and a fledgling firm. How we got to what is now Flagship Healthcare Properties, again, we were focused on the investment side at the legacy Flagship, and in 2008 we purchased a building from another local firm called the Brackett Company, and the Brackett Company had been started by Diane Brackett Rivers in the mid-1980s. She was and remains a force in real estate, and back in the 1980s, not a whole lot of women-owned real estate development firms in Charlotte, so she was certainly a pioneer. Well, we bought a building from the Brackett Company, but we didn't have the skills to maintain and manage that property and lease that property, and so we engaged the Brackett Company to do that for us. And so again, this was around the 2008 timeframe, heading into the financial crisis, and as we looked in the mirror and said, they've got relationships with the tenants, they know how to take care of these assets, and we're a fiduciary to our investors. When the investor calls and says, how's my building doing? We didn't want to have to say, I don't know, let me go call this third-party firm and find out how your investment's doing. We thought there's some power there if we can have all of that under one roof. And so 2010, we formed a joint venture, and we literally paid a marketing firm to come up with the name Brackett Flagship Properties. I mean, they just took the two legacy names and stuck them together, and I remember.
They took a fee too.
And they took a well-earned fee. And so we launched this joint venture with really no assets, and we both just contributed kind of manpower to launch this firm. And over the next few years, we tried to figure out how much revenue do we run through that firm, and how many expenses do we run through that firm. And that's where I was tapped at that time to really grow and integrate that company that's now Flagship Healthcare Properties. And I think, I wish it was. I was tapped because I was the brightest and the most hardest working, and I think it was really that I was viewed maybe as a neutral, that I wasn't part of, I wasn't embedded into one or the other legacy firm, and so that was my goal, was to integrate these two companies through growing this new venture. And we started in 2010 with a combined company of about 17 or 18 employees, and then lo and behold, that joint venture has grown and really kind of became the entity that where all the business is done now, and it's been fun. We went from, again, 16 or 18 employees, and now we have about 109. So wow. It's been a fun ride, but we're just getting started.
Absolutely. So for the initial formation of the Brackett Flagship Company, what was the focus of that firm? Was it, you said there were no assets there. Obviously, maybe Brackett retained the properties that they owned, right? So you form a new entity. What was the focus of that entity? Was it solely for healthcare properties? Because prior, Flagship did other assets as well.
In the first few years of the legacy Flagship Capital, it was a young real estate firm that was looking for good investment opportunities in the real estate space wherever the phone rang. So if somebody was calling and said, hey, we got a piece of land and it looks really interesting, well, we'd dig into that. About 2008, as the financial crisis was upon us, that was the last general office or non-healthcare deal that the legacy Flagship did. And thank goodness that was the case, because healthcare has been a tremendous sector through the financial crisis, through the pandemic, even in today's environment with higher rates, and we can talk more about that. Mm-hmm. Some people hear medical office buildings and they focus in on the office and go, wait a minute, this is a worrisome sector. And so some of the folks in our space, and a lot of the lenders in our space are now keeping the MOB initials, but they're separating, they're swapping out office for outpatient. And so some folks will say, oh, well, you're in the medical outpatient building sector. And it's semantics, but it's true that it's different. It's very different from characteristics from what folks in the general office environment are experiencing now.
Absolutely. So you're not only does the company radically change shape and become this structure where we have a REIT section with $1 billion assets, $1 billion in asset value, and then we have all of these different services. But your career changes along the way too. So like, what is the trajectory, or what is the story of evolution rather of this new joint venture, and when did you start adding other services? Today
Sure.
we have asset management, property management, construction and development, and then obviously the REIT too. So like, how did the company evolve over time, and were there any critical points along the way of maybe buying a portfolio of offices or any larger acquisitions?
Sure. So our structure of how we have invested and deployed capital, and from where we've gotten that capital, has changed over the years as we've grown. So up until the early parts, predating the launch of Flagship Healthcare Properties, in both of those legacy companies, all of those investments were really one-off transactions. So in the case of the legacy investment firm, we would go out and say, all right, we found this great opportunity. Let's pass the hat to a number of high net worth individuals, or let's work with one family who needs or wants to deploy capital into this medical space. And we did that time and time again. And we did it 25, 35 times. And by and large, it worked pretty well. We didn't always outperform our pro formas, but usually we did. But it wasn't generating a lot of efficiencies for the firm, and it wasn't providing a whole lot of diversification for our investor clients unless they happened to be in all 25 or 35 deals. And so if we've done 25 deals and 24 of them outperformed and one of them barely met budget or underperformed, if you're only in that deal, you don't so much care that our average IRR has been mid to high teens. You care that the one deal you got in was less than what you were expecting. And so I describe that time in our evolution as we weren't managing a portfolio of 35 properties. We were managing one property 35 times over, because everything was segmented. You had separate bank accounts and separate leasing teams. Everything was separate. It had to be. But in 2012, we made our first shift and said, we can fix that, and we're going to fix that by launching a closed-end fund. And so we raised our first closed-end fund, and we had discretionary capital, and all of a sudden we could go and move just as fast or almost as fast as some of these larger competitors who could say, well, yeah, I've got a designated line of credit, and we can buy this asset and do our due diligence in a relatively short period of time. And so we did our first fund. We did 2 years later our second fund, which was a joint venture with USAA Real Estate Company out of San Antonio. We started our third fund, and around this time we were raising money for our third fund, and our first fund was approaching 5 years in existence. And so the market was good. We went to our investors and said, look, this is a good time for us to probably liquidate this fund that you're invested in.
It's like 2017-ish?
That's right, exactly. 2016 in the beginning of 2017. And we thought, this is going to be well received. And instead, our investors said, what are you doing? No, we don't want you to, these properties are appreciating. They're throwing off good cash. We like this. Don't sell it. You're going to cause me a tax issue because I'm going to have to pay gains, and you're going to cause me a reinvestment issue. I don't want this money back. I want this invested in healthcare real estate. And we said, well, all due respect, this is how a closed-end fund process works. And they said, well, fix it. We don't like that. And so we spent the better part of 2017 working with a host of advisors to say, how can we better align our three main constituents? How do we get a better alignment of interest between our investors, who are all accredited but are predominantly longer term in nature, and are tax sensitive, and they don't want to be buying and selling, so they're longer term, our tenants, who are healthcare providers and systems, and I would argue more so than most any other real estate sector, they care who owns and manages their buildings. I mean, it's different than if were a tenant in an industrial building, or if you're a tenant in an apartment complex. I mean, there you care. Do they have amenities? Is the price right? Is the location good? Is it safe? For us in the healthcare sector, when the physician calls the hospital executive and says, my roof is leaking, the carpet's frayed, and the parking lot's starting to alligator, who owns this building and can get them to fix it? Well, if we're a short-term owner and we're planning on selling this flipping it in 6 months, we might not be inclined to take care of the roof and to replace the carpet and to fix the parking lot. But we're not short-term owners, and so we want to manage these assets as if we're going to own them forever. And we don't own all of our assets forever, but we go into the purchase or development of an asset thinking that we can. And so we want to take care of it like we're going to own it forever. That's a different mindset than maybe somebody with a fund that's got a 4-year life. And lastly, we had made the decision in 2010 that how we were going to compete was not to be the biggest and to have the lowest cost of capital, that our secret sauce was going to be our people, and that we were going to have the best leasing team in the industry, and we were going to have the best property managers in the industry, and the maintenance engineers that knew these buildings inside and out. And that model didn't necessarily jive with a short-term fund model. How do you employ the best property accounting team in the business if every 2 or 3 or 4 years you liquidate a third of your portfolio? And you could explain it away and say, well, we'll just keep growing funds, and maybe that would have worked, but it didn't feel like there was a great alignment there. And so we studied all different kinds of structures of how we could try to create a better alignment, and we settled on the private REIT structure. And a private REIT structure at the time, I didn't know much about it, and I remember talking to one of our advisors who was throwing this out as an idea, and I said, look, I don't know much about the private REIT space, but if that's the vehicle that I read about on the front page of the Wall Street Journal that has high fees and low transparency and a business plan that says, I hope something good happens in 10 years, I don't think that's for us. And that's painting with a little broad, overly broad brush, but 20 years ago, that was a pretty accurate description of what were public, non-traded REITs. And that industry, that sector of the industry has really cleaned itself up in recent years with big names like Blackstone and Starwood and groups that have made it much more transparent. But really, there's public listed REITs, there's public non-traded REITs, and then there's what Flagship is structured as, which is a private REIT. And I describe it as an open-ended vehicle, so we don't have a finite date when we're going to sell everything. That happens to be structured as a real estate investment trust, so there are some requirements for us to be a REIT, and there are some benefits for investors on the tax side and on the dividend side that we can get because we're a REIT. And we so this was, again, 2017. We went to all of our fund investors and said, look, we think it makes sense for our investors and our operating company and our tenants to make this shift to a private REIT that doesn't have a finite timeline. But we realize we're changing the rules of the game in the middle of the game. And if you don't want to do that, we understand. And we got everything valued at that time, but we had about 94% of our investors by capital say something along the lines of, this makes a ton of sense, we're in. And so that's what led to the launch of the REIT at the end of 2017, beginning of 2018, and started with about $55 million of equity and invested, and have since grown that to 420 some odd million now.
So what is the actual transition period? So there's those 3 or 4, and maybe I'm misquoting that, but 3 or 4 closed-end funds that you have at the time, and they don't want to sell those assets. How do you migrate those closed-end funds into the REIT structure?
Sure, great question. And so we had to involve a whole lot of outside advisors and valuation companies to do that. But essentially it involved getting everything valued, each of those funds, any one-off properties that existed, to determine what those values were. And then those investors that said, I'd like to take my capital and go elsewhere, we paid them out. And those investors who said, I want to be in this vehicle and grow with it, received shares or operating partnership units in the new venture. And the vast majority of those investors who made that contribution are still with us today.
Wow. Are there any economies of scale as opposed to obviously have the 35 different ownership deals, right? And then you go to the closed fund model where you have 3 or 4 of those, and then the REIT structure. There's got to be value or economies of scale in maybe in pooling insurance.
Absolutely, yes.
Cost of capital.
That's one of the benefits, yeah.
What else became a value to you that you guys maybe didn't think originally? Right?
Sure.
Wow, this really new structure.
There were several, and some are obvious. We don't have to get an audit for 3 or 4 or 5 different vehicles. We get one audit now. And so that's easier for our Big Four accounting firm to do that, and more cost effective for us. Insurance is a big one, so we can pool our insurance together. And if we're managing a property on behalf of a third party owner, they don't have to use our insurance capabilities. They may have perfectly good relationships, but we can offer that, and so we can generate some of those economies. Same with vendors. If we're using landscaping companies and janitorial firms, instead of having 1 or 2 properties, well, now we've got 319 or so that we're managing, and so it makes it gives some economies of scale there. And lastly, financing is something that makes it's a big deal. And so rather than having to get one-off financing on every individual asset, we can now use our portfolio to get better terms. We can make our lenders feel better because we've got more scale and heft and cash flow. So it's really a win-win there.
So migrating kind of to the second part we were chatting about before we started recording. So we have this dual structure to the company. We have the all the properties that you guys own, and then obviously there's a robust amount of properties that you guys don't own, but you also provide services to as well. So focusing on the service side of the business, how are you guys getting so much business? You work with Starwood, if you want to talk about that, it seems very cool. But how are you able to continuously pick up new properties to manage? Like what is the origin of like all of the new deals for management, and then
Sure.
Is there a plan to buy those properties or get them into the REIT in the future? So how does that?
Great question.
mesh
So
together?
yeah, we again, we have just over 100 properties in the REIT that we own. We've got some joint venture partners in those built in 15 of those buildings or so. So we may buy a building or want to buy a building. A tenant in the building may want to buy the building also, and so we may buy it together. So that's about 15% of our properties. But then we've got 200 plus buildings that we're managing for third-party owners, and we work with a lot of the public listed REITs in the healthcare space, and we're fortunate. I mean, people ask about the differences between publicly traded REITs and private REITs, and which one's better and which one's worse, and I don't think one's better or worse. They're just different in terms of they're different product. They're a different investment. And so, again, we made our bet as a business was to develop the relationships. And so we've been fortunate that some of these larger public listed firms and large public non-traded REITs and large investment firms recognize that we've got relationships in especially the Southeast, where we can take care of those assets as good or better as anybody. And so that's just been a manner of growing with our clients, and we're grateful that they entrust us with the care and feeding of their assets. So that's been something that has continued to grow. We also have a great team in-house that not only is good at taking care of these assets, but are constantly looking, in all of our markets for, are there other buildings that look like the buildings that we have that maybe we can take care of? And so we'll constantly be proactively talking to owners. it's not that it is not the goal that we're going to go manage a building and then buy it from them.
Yeah.
However, that happens a fair amount of times. And so for whatever reason, a third-party owner may decide, we don't want to be in this location anymore with an asset. We're going to make the decision, the investment committee has made a decision to get out of the state of Y or the county of X, or we've owned this asset for 10 years and it's time to sell it because we want to return capital to their investors. Well, it's kind of normal that they'd say, well, who would be a likely buyer for this? Well, we've been managing the building for the last 5 years. We know it better than anybody.
Every inch of it, yeah.
And so that's a way that sometimes acquisitions come to us, is just because the current owners are ready to recycle that capital. But even if that never happens, we and our other clients get the benefit of having that really deep pool of knowledge, because we're managing 300 plus buildings. We should know, what's it cost to, what is janitorial per square foot supposed to cost? Who are the best providers? How can we save money on maintaining roofs, or where do we find the best painting contractors? Those things, we hope and we believe they do, provide value to everybody in our portfolio, whether we own it or whether we're working on behalf of a third-party owner.
Wow. Is there any service you guys don't have right now on the service side of the business that you would like to? I mean, it seems pretty airtight end to end of everything that you provide. But just in general, is there anything in the future that you think, I don't know, maybe bolster your offering or maybe get you into a new market or something like that? But out of the current services right now, is there anything else you guys think you would get into?
Yeah, that's a great question. We're one of our newer lines of business, or kind of offshoots of our management side of the business, is on the ambulatory surgery center compliance side. So we do life and health safety, and surgery centers are, even though we're not owning properties that are overnight stay, ambulatory surgery centers are where over 60% of the surgeries are happening now. So it's, it used to be everything was done in a hospital. Now that's shifted, and even the hospitals and certainly the insurers are pushing people to ambulatory surgery centers. And so we have begun and now are really good at the compliance side, because if something is out of compliance and there's a joint commission that shows up to inspect a surgery center and something's not working, that center's offline, and that's a lot of revenue for the owners of that center, and that's a lot of aggravation for those patients that need whatever procedure they're waiting on. And so we've launched that line to go out and work with ambulatory surgery center operators to say, here's how we can help keep your facilities on track, in compliance, so that you limit the downtime that you have in these properties, which is good for everybody involved. Sure. And that's something that historically it's not. It's often been done, by a administrator of a center, or the head nurse, nursing officer of a center, and it doesn't mean they can't do a great job at it, but it's something that we can do that's not just one more thing on that employee's plate, and we can be really, really good and know how to do it efficiently and effectively. So that's an area that we've grown. We're doing a lot more construction management, both for firms that maybe are trying to build out something, a new space. They may own it themselves, but say, we need somebody to work with our general contractor and help us think through space planning. We need somebody to work with our architect. How big should this space be? How should the layout be? Wow. And so we're working more and more with both tenants and clients who aren't tenants, and to grow that line of business.
To stop there for a second, so for those construction management projects, are you being pulled in to obviously help with the design, we'll call it layout, whatever the individual details of that engagement may be, but are you also doing that on the back end, that now you're going to be the property and asset manager after it's developed too?
Sometimes. Okay. Sometimes it is a finite engagement of, hey, we need to get X number of people or X number of services into a space. How do we do that efficiently? Other times it's, let's say it's a third-party owner who says, we've just signed a new lease with a tenant. We need you, Flagship, to represent us as the landlord to make sure the general contractor that the tenant's hired is doing things the right way, that we've got stuff built to code, that no corners are being cut. Are there ideas or best practices that we can help out with? Because those owners, whether it's Flagship or it's a third party, they're a fiduciary. So they want to make sure that permits are getting pulled and the things are done the right way so that the building's not at risk, the asset's not at risk, the tenants aren't at risk. So, I think I know we will continue to grow those lines of business. You've seen some companies go even further vertically integrated with buying or owning a general contractor company. That's not where I see us going. We do have a very robust maintenance and engineering program. We could continue to build those skills out to take on kind of higher levels of whether it's HVAC or plumbing. If there are ways that can save our tenants and our clients money and also be profitable for us, we'll explore those. But there's nothing wholesale that we're looking at shifting. It's not as if we're going to go into, all of a sudden be senior housing or skilled nursing, that's just a different animal.
Jumping back more to the REIT here. So if we touched on it a little bit, I think with those deals that you manage that sometimes come back to you as a potential buying opportunity. But what would be the source of most deals for properties that you're going to acquire that will be in the REIT? So obviously we have stuff that's just marketed through a brokerage and it comes to you. We have stuff that you guys manage, but what is also, so number one, what is the source of most of those deals? And then number two, what is the value for so many of the physicians that may own the building to want to get that property off the books? It seems like there may be a push to that and free up some capital. So kind of like what would be a good overview of the deal space or sourcing of new properties for the REIT?
So we've got a team of development, team of acquisition folks, team of development folks. We've obviously got leasing and property management. They're in our buildings and other third-party buildings every day, and so our people are constantly sourcing deals. When somebody's in our building, here in Charlotte says, we want to operate a satellite office in Mooresville, or we want to open a location down in Charleston. Can you help us with that? Sure, yeah, we can. And so that can be the genesis from our existing tenant base or physician groups who say, geez, we've worked with Flagship to develop our first office building, and it was a pleasant experience. Let's do it again. Word of mouth. So we've grown our REIT about over a third of our capital in the REIT has come from building sellers who have elected to upreit a portion of their sale proceeds. And so that was something we didn't expect when we launched the REIT. But in a layman's term, a Section 721 exchange or an upreit is where a real estate owner exchanges their interest in one asset and receives operating partnership units, which are really share equivalents in our REIT. And there's not a taxable event associated with that at that time. And so, often we'll have a group of physicians who own a building and for any number of reasons decide, I don't think we want to own this building anymore. Maybe it's some of the physicians are nearing retirement age and they're looking to liquidate. Mm-hmm. Maybe it's younger physicians who say, I really love medicine. I'm not interested in the real estate, so I don't want to buy in. I don't want to tie my capital up into a building. And so or it's a physician group who may have 30 physicians and half of them own the real estate and half don't. And you can imagine some of the conflicts there when you've got half the group that says, we want to charge the highest rent in the world, and the other group says, I don't want to pay for your child's private school education. Sure. I want the lowest rent. And so that can cause some internal conflict in groups, and we can be a solution for that and say, look, why don't you sell your real estate and you can take, for those of you that want to remain invested, you can upreit, get shares or units in our REIT. It's not taxable at that time. You diversify from owning a piece of one asset to a piece of more than 100 assets, and including still that a piece of the building that you're now practicing in. And so word of mouth has been a great way for us to grow. healthcare systems, some are adamant that they want to own their real estate, and that's fine. And others are making the decision that capital is precious, and we may want to own our acute care hospitals, but maybe we don't need to own this medical office building that's off campus. And so they could say, well, we could use that $10 million or $50 million of capital to go buy the latest technology or hire a new set of physicians or buy a new practice. And so it's providing capital for healthcare providers to do what they do best, which is deliver healthcare.
That's right. How has the raising equity or just the growth of the REIT itself evolved over time? So in the initial maybe flagship days, you have all these individual transactions, and I'm sure it's heavily based on maybe your original partner's track record and his private relationships with guys and gals saying, hey, we got this deal, we're going to buy this apartment building. You have someone that comes to mind. Now you're in a whole different ballpark of there's a lot of different people that want to invest in healthcare. So how do you market the fund, or like do you guys work with other advisors? Like,
Sure.
Is there a target market for where you want the fund to go in a growth path?
Sure. So our roughly 450 investors that we have in the REIT are broadly broken down, and this isn't exact, but roughly speaking, 45% of that capital is from family offices. And these can be single family offices or multifamily offices or groups representing multiple family offices. About 45% is high net worth individual investors, and that could be somebody who knows Flagship directly and says, I want to buy shares in the REIT. Or more and more frequently, registered investment advisors, groups of wealth managers who have accredited investors, and they say, you know what, my investor pool, they want stocks and bonds, but they don't want a 60-40 portfolio anymore. They want to introduce alternative assets to their pool. And so we are developing and have developed relationships with registered investment advisors on behalf of their individual clients who say, yeah, I want some exposure. I don't want to put all my eggs in a healthcare real estate basket, but I want to have some of my commercial real estate exposure in this sector because the demographics are good and the resiliency of the sector has been proven. So that's about another 45%. And then about 10% are institutional. So that's the kind of the newest part for us, and so we're out starting to market abroad now. So in Europe and the Middle East and in Asia, it's still very much a minority part of our investor base, and because we're structured as what's called a domestically controlled REIT, we're always going to have a majority of our capital come from the U.S. But what we've realized is that dividend-paying growth real estate assets in a sector that is attractive from how we're delivering care in the United States and geographically where we are in terms of demographics, that resonates outside of just the U.S. And so we want to make sure that we're broadening our investor base. So that's how it's changed, is that we're now and we're growing. So if we were raising smaller amounts of money 10 years ago, now we have the capability to deploy more and more capital, and so we are growing our investor base. That we need to grow our investor base. As a REIT, 90% of your taxable REIT income must be distributed to shareholders. So we can't, which is great for shareholders because they know that their dividend's coming. If we're generating cash, they're getting a dividend. Right. The challenge for the REIT is that if we want to grow, we can't just retain earnings and then start to. Equity. We got to get new equity or new debt, and we're approximately 50-50 between debt and equity. I think we're about 52% levered right now. So for every dollar we're buying in new buildings or dollar we're developing in new buildings, roughly speaking, we're taking 50 cents in equity and 50 cents in debt. So if we want to grow, we've got to raise equity and debt. The nice thing about our structure as a private REIT is that we don't have to grow. It is a lot more fun to grow, and our team is, there's more opportunities when we grow. But if we don't see compelling opportunities out there in the market, we just stop taking new money. And we can just, our rents are growing 3 to 5% a year on our existing portfolio. We're 94% occupied across the portfolio. So we can just, as hard as it is sometimes, we can just sit back and say, let's make sure we just manage these assets most efficiently. And when we're ready to pounce on an opportunity, we can pounce. It's the environment with higher interest rates makes it tougher in this environment than it was 2 years ago. That's not necessarily a bad thing. I think some folks will probably get washed out of the industry, but we are actively seeing growth in our pipeline right now, and there are opportunities that I think we will be closing on in the second half of the year that are attractive, and in 3 years and 5 years, we'll look back and say, thank goodness we bought these assets. So, one of the most important jobs I have right now is making sure we've got the equity pipeline lined up, because we have the ability to deploy that capital now, which maybe 12 months ago, 18 months ago, we didn't. So I'm actively out on the campaign trail. We're as a Reg D private placement, we're not allowed to publicly market. We can't go put an ad in the newspaper, and nor would that be appropriate. But for accredited investors, whether they're individuals or families or institutions, we're open for business.
Speaking along that growth trend there, how do you evaluate obviously primarily from Maryland to Florida, and you can correct me on geographically, but being this mid-Atlantic, southern mid-Atlantic to southeast focused, I'm sure you're going to keep expanding and potentially into other markets, or maybe there's some certain gaps in the southeast that you haven't been in that you want to. And I was reading something, or maybe another show you did, you spoke about a lot of people just focus on primary markets, and we're able to focus on secondary and tertiary, because obviously they still need medical office buildings in those markets. So how do you evaluate the growth plan geographically, and then also, separate question, but just asset allocation of the fund itself? So core versus value add, and then we have this development function, which I have a couple questions about too. But how do you balance the fund in your eyes, and why is the fund structured the way it is? And two, how do you and the team look at evaluating new markets that you want to be in that you haven't yet?
Sure.
Well?
So you're exactly right. We're on deploying our capital. We are focused on the southeast and southern mid-Atlantic. So roughly speaking, Maryland to Florida, over to Arkansas, Tennessee, and Kentucky, and that's where the bulk of our market, investment capital market is. We manage properties in 19 states because we have relationships with other third parties that want us to do that, and so that's great. But when we're deploying capital, our focus is on the southeast, and people say, well, why is that? And it's a couple of reasons. One, it's because that's where we're based, and healthcare is really like real estate. Healthcare is local, or at least regional, and so we don't have the relationships in California or Alaska or Hawaii where we can make better decisions than somebody that's there locally. So we want to stay in markets where we have relationships. Number two, the Southeast, you read about it everywhere you go, that it's growing. Why? Well, why is it growing? Well, we've got good jobs, and we've got lower taxes, and we've got great weather. But it's not just young professionals that are moving here, which is important. But for healthcare, it's the seniors that are growing in the Southeast faster than overall population growth, and certainly faster than population growth in the Southeast. So it's moms and dads and grandfathers and grandmothers who are saying, you know what, I'm going to retire and I'm going to leave the Northwest or Northeast or leave the Midwest, and my kids are already in the South. They're in the Carolinas or they're in Florida, and I want to be closer to that family. And oh, by the way, there's great health care down there. So for us, our business plan is really, how is healthcare changing? Well, it's moving and has been from inpatient, come into the hospital to receive care, to now outpatient. So better care, better convenience, better cost can be delivered in that way. And so that's kind of buildings that we're buying. Yeah. And then, okay, if you're 60, if the average adult goes to the doctor 4 times a year, when you turn 65, depending on the source of data, you're going on average 6 or 8 times a year. And you turn 75, you're going 10 to 12 times a year. And the dollars you're spending on healthcare are ramping up exponentially. And so, all right, why do we look at the Southeast? It's the same reason people, you fish where the fish are, and that's where the opportunities are. Yeah. So will we grow and expand? there are attractive markets that we're not in, in the Arizonas and the Denvers and markets in Texas. And at some point we may explore those areas. I describe our southeastern and mid-Atlantic investable universe as being about $160 billion of outpatient healthcare real estate. We own in our REIT about $1 billion of it. Now, some people will say, yeah, but hospitals own about 50% of that $160 billion. So maybe the market is only $80 billion instead of $160 billion. I disagree with that because I think more and more hospitals will start to monetize their assets and say we can be better stewards of our capital by taking the money out of the real estate and putting it into the healthcare.
Wow.
But regardless, whether that market is 80 billion or 160 billion, we're 1 billion today, and I see a pretty clear path to go from 1 billion to 5 billion without having to change the borders of what we're looking for. How do we introduce? How do we grow? And how are we evaluating new opportunities? One of the we hired 2.5 years ago our first chief investment officer, and that follows along the line of thinking that I have that I am and continue to be the weakest link at this company, and I say that proudly because we've got a lot of smart people and a lot of experts here.
Right.
That are much better at what they do than what I do. And so my job is to stay out of the way, try to provide some guardrails on where we're going, but then hire great people and let them be great. And so new CIO comes in. We've established a scorecard that looks at our real estate. We were, whether we were good at it or whether we were fortunate, we bought good assets by and large. But we're now entering that phase of our evolution where we need to be even more buttoned down and documented into our processes and our thinking, and how does our investment committee evaluate new deals. And so that's just one example of how we continue to increase the scale and the skill that Flagship as a platform brings to bear. So we want to be even more regimented about how we look at the opportunities to make sure we're making good investment decisions.
Yeah, that makes plenty of sense. There was one thing.
You mentioned the breakdown between our assets.
Yeah. Okay. So one part about that, the value add part, I get. Obviously, we can drive a little bit higher returns, but it makes up a smaller percentage of the portfolio. But for the development side, if you want to spend a minute, I was just curious about how does development look in a REIT, right? Because it's not throwing off any revenue unless you're taking a developer fee along the way, and maybe that is kind of the income producing portion. But what is the function and what are the challenges of developing an asset from scratch in a REIT? That's
a great point. And so our makeup of how we've deployed our equity capital to date, you look back since the REIT was formed, it's been about 65% of our capital has gone towards core or core plus buildings. So those buildings that are 100% occupied if they're single tenant, or 90+% occupied if they're multi-tenant. So about 65%. About 24% of our capital has gone towards value add buildings. And for Flagship, a value add building opportunity is not an empty building that's been foreclosed on 4 times, but by George, we're going to get it the 5th time and we'll be smarter than the previous guys. No, it is, generally speaking, a building that is existing, that it is not functionally obsolete, but that there is something keeping that building from realizing its full potential. And so an example of that could be an out-of-town owner owns a medical building but doesn't have relationships with those healthcare providers. And so they've been stuck at 70% leased for the last 5 years because they haven't been able to introduce new life in leasing. Or a physician group that owns their own building and they occupy 30% of it and lease out 70% of it, but they've never gotten above 60% occupancy. And you talk to the practice manager and he or she says, I got 100 things to do every day, and filling up this building is number 101 on that list. I just don't have time to do it. Well, we do. or it's a building that needs capital or a refresh, and the current owner doesn't have the ability or desire to do that. So that for us is the value add opportunity. And you're right, we can buy those buildings, we buy them right. They're throwing off some cash, but not great. But once we stabilize that, that's where the real opportunity is. On the development side, historically, that's been about 11%. And so an example of that is a client like a university health system says, Flagship, we want to have a medical office building and urgent care in this particular market. Go find a site, get it entitled if it's not entitled, work with our architect and our GC, or help us find a GC, develop that building, and then we'll lease it back from you for 15 years. And that's a core competency that we have. And my goal is to get that from 11% closer to 20%. But you raised an important point in that as a REIT, we've got a dividend that we've got to cover and generate and continue to grow. And if you're developing, you're not getting any cash for 24 months or so while you're moving dirt. And so in our early stages, we were relying on outside capital to essentially fund the entire capital stack for the development process, and we would have to share that development creation, that value creation, with that capital. As we've grown, and we're still, I think we're still pretty small potatoes, but as we've grown, we've gotten bigger so that we can take on more and more of that ourselves. That's good for our investors because then we don't have to pay out half of that upside to a funding source. So we will never be a 50% development REIT. That's not the right structure. But we love developing to own. That's really one way that we'll continue to grow, and we can generate better returns for our investors on the development side. So ideally, we'd be plus or minus 60% core plus, 20% value add, 20% development.
Wow. One question that stood out when I was doing my prep. So in 2022, and we can spend a little bit of time here, but it seemed like there was a pretty large credit facility, which may open up a lot of different doors for you. So $265 million, there was $100 million revolver, and then $165 million term loan. What was the strategy in pursuing kind of this new financing structure? Was that dependent on one deal that you were putting together, or what did that make possible, or what did that help for the REIT operations overall? Yeah,
it was a major turning point for us, and I'll start with the punchline, which is that it's better to be lucky than good. The timing of that, it was. I mean, I wish we could say, that we saw the coming inflation. And got out ahead of it. We saw some of the capital crunch that was coming and beat it, beat it to the punch. In reality, we started the process and we ended up inking that deal in July of 2022, but it was fairly well baked by late spring. And so we negotiated what in hindsight is really attractive pricing. We locked in good terms. We've got great banks. The Fifth Third leads that facility, but we've got 9 other partner banks that we have great relationships with, and so some of those we just met through that facility. It gave us, as you mentioned, $100 million in revolver capacity, and when interest rates started moving up, we swapped the vast majority of our debt at that time. We're still over 80% hedged, so. The higher for longer situation, we planned for that, and I wish we could have swapped 100% of our debt. So it's not that it doesn't hurt higher rates; it's just it doesn't hurt as much. But that gave us the ability to close on some deals when maybe capital wasn't as available for other borrowers. I will say that the medical office, the outpatient sector, has fared as it did during the financial crisis, as it did during COVID, and even now when commercial real estate is a 4-letter word for a lot of folks, the healthcare sector, specifically the outpatient, has really fared really, really well. So occupancy, renewal rates, they've all done really well in our portfolio.
So the real estate performance of those assets certainly obviously outperforming the other asset classes. However, insurance and rates still impact you guys just as much as anybody else.
Absolutely. So,
Which is tricky.
costs are going up, and electricity goes up, all utilities go up, and, the cost of service, janitorial and landscaping, and insurance is a major one, especially in coastal markets. We have about 7% of our leases that are full service gross. And all that means is that the landlord's responsible for everything. Tenants pay you a monthly rent, and if costs go up, that's on us. But about 93% of our leases are either triple net or absolute net, or there's a base year stop. Something is structured where the tenants are paying all or at least a large portion of increases in operating expenses. So that doesn't mean we don't care about it, because if we've got a building that's got super high insurance and super high property taxes and super high operating expenses, we can't just wash our hands and say, well, that's too bad. The tenant's got to pick all that up. Because if it gets untenable for the tenant, or they feel like we're not doing our part to keep costs down, then they're going to move. And that really would not be good for our business model. So we care about operating expenses, whether we're paying for it or the tenant's paying for it.
Right. In lightly wrapping up, Brannen, is typically we'll talk about one deal or maybe a couple, but on each show, just in general, you can think about it, but anything that sticks out to you as a significant deal in growing the REIT or just in Flagship's history in general. Could be an acquisition of portfolios. Could be, we can even spin it towards the service side of the business of working with someone like a Starwood or maybe the other publicly traded REITs. But any transaction or deal that I saw something about a rubber chicken too, and maybe this is the deal chicken okay, that I was looking at. I wanted to ask about that. But anything that you kind of look back fondly of in growing this REIT and obviously doing it. It seems like rather quickly to the size, but any deal that comes to mind?
Yeah, we've had a couple of portfolio deals that were game changers for us. We bought the Cabarrus Family Medicine portfolio, which is Cabarrus County, now part of Atrium Health. We bought the Lexington Clinic portfolio in a sale leaseback in Lexington, Kentucky. That was a transformative deal with a great client and great partner there. But I'll tell you, the biggest transformative thing from my perspective isn't a deal. It's something, and it relates to the deal chicken that you mentioned. That's a quarterly award we give out for somebody that's doing something special and meaningful in the company. And I'll go back to several years ago. We worked with a consulting firm to identify the core values for Flagship, and we did that in a process. Groups called Spark, and Spark worked with us to identify what did some of our tenants, some of our investors, and some of our employees, what did they view as being what makes Flagship special, and out of that process, which was several weeks or months in the making, there were 5 core values that bubbled to the surface, and they were being considerate, being responsive, being optimistic, pursuing excellence, and being grateful. And those are our 5 core values. You don't often hear you hear about excellence from from companies or teamwork. I mean, there's kind of usually they're just the status quo, and you don't often hear about being optimistic, which is one of my favorites, where you kind of make your own luck. If you're pessimistic and think there's no chance this is going to work, you can rest assured you're going to make sure there's no chance it's going to work. Right. But if you believe there's a path to achieving success or solving a problem, it really becomes a self-fulfilling prophecy. Or grateful, not one that we often hear on the pillars of Fortune 500 companies. That's not grateful that, geez, we didn't deserve this victory, or we don't deserve to have this tenant or this client or this investor, but it's just a recognition that there is somebody else in every interaction, every transaction, and they don't have to work with you. They can work with their sister-in-law. They can invest in a different client. They can choose to relocate to a different building. No matter how good we are, even if we think we're the most deserving option, somebody else has made a decision to work with us, and for that we're grateful. And consider it's an easy one. How do you treat people the way you want to be treated? Just so our tenants and our investors came up with responsive. Why put off for tomorrow what you can do today? We don't want to. We don't want to. Even if they don't think it's an emergency, let's get it done now, and that can be good for investing, and that can be good for tenant relations. So that is something, that process of determining or highlighting, uncovering those core values is something that we talk about every day or at least every week here, whether it's interviewing new hires. It's something that we want to inform how we do business. We gotta make good investment decisions. We gotta make sure we're maintaining the buildings well, but we're going to treat each other like we want to be treated, and try to preserve and grow this culture so that our colleagues, my colleagues that come to work, it's hard work. So you want to be around folks that are helping to preserve and engender a strong culture. I know that's not a specific deal, but that's probably the most meaningful thing and a pivotal point of our growth and evolution, at least from my perspective.
Yeah, I love it. That's a great answer. So in wrapping up, last couple questions for you. What is if we can separate it between Flagship Healthcare Properties and then the REIT as well, but what is the team focused on right now? I know you said maybe there's some transactions potentially coming up later this year, but anything, and obviously amidst this tumultuous market climate too, what's the team focused on right now? Like what's important on both sides?
Sure. So on the operating company side, I mentioned earlier about our ASC compliance business. There are as many surgery centers in the United States as there are hospitals, and the number of hospitals is coming down and the number of surgery centers is going up, and so that is a major growth area for us. And Corey Stein and Blake Bratcher and Joe Schull, our team that are focused on that, that's a major push for us, is we can help those surgery center operators save money, be better, stay open and more efficient, and we can do that profitably for us. That's an area of focus. Construction management, whether we're doing the development or somebody else is doing the development, will continue to grow. Property management services, I think more and more healthcare providers are appreciating providers that focus on healthcare exclusively. We don't have an industrial division. We don't have a self-storage division. We don't have a multifamily division. All we know is outpatient healthcare, and so I think there's a benefit in being a specialist. If I'm going to have brain surgery, I want to go to the specialist, not the generalist. So that's an area that we'll continue to grow on. On the REIT side, there is opportunity that is now coming down the line. And so what we're going to focus on is making sure that we've got the equity capital to take advantage of those opportunities. We don't want to be more highly levered, so we want to make sure that we're growing the equity along with our banking partners. So that's a major focus, is make sure we've got the war chest to be able to take advantage of these opportunities that are coming in the months ahead.
I love it. Last question for you, and if we missed on anything Flagship related, we can jump back to that too. But who do you think along the way, this could be from banking days to modern day, and you can spin this any way that you'd like, but who do you think helped you the most along the way, just in your career, learning the business, learning how to do deals, maybe growing your skill set, obviously from intern to running a company or leadership, being the CEO? Who do you think helped you the most along the way?
Yeah, I mean, it sounds trite, but I first would give a ton of credit to my parents. I was fortunate to be raised with a loving mom and dad who imparted to me, the benefit of education, of hard work, that entrepreneurship, humor, that hard work and a career didn't have to be a grind, that you could have fun. And I do have fun. I love coming to work every day. I love the people I work with. And I attribute a lot of that to growing up in a home with a loving mom and dad. So that would be the first spot. Second one would be my former business partner, Charles Campbell. He hired me as an intern, gave me a chance. We worked together for the better part of 1.5 decades before he passed away. And he was a major influence on my life and how to approach business and communication with folks. And then I had some great mentors at BB&T back in the day. I worked for a number of great leaders, some of whom I get to now work with on the other side of the table. But folks like Bill Newbold and Ted Wolfe and Ernie Dahnert that really taught me a lot about life and business and banking and how to treat other people, which was invaluable. So again, I have been very fortunate to have folks that would pick up the phone when I called and said, I don't know how to do this, and you don't know me from Adam's House Cat, but can you meet me for coffee? And so I'm hoping that I can at least try to pass that, pay that forward and pass that along with kind of the next generation.
Yeah. Last question for you. In any respect, did we miss anything, or is there anything you wanted to finish with just on overall for Flagship as a whole? Is there anything we missed that you think is critical to the story, or anything upcoming that we missed for Flagship Healthcare Properties?
I think you've done a great job of highlighting kind of all the different aspects of outpatient healthcare real estate. We have an amazing team. We can still screw it up. We can make bad investment decisions. We can miss the boat on hiring an employee or a vendor. But no doubt, I've made 10 mistakes today, and I'll make 10 more before the sun sets. We've got a really, really good team. That is what sets us apart. That and our specialization in the outpatient sectors. I don't like to bet against population growth, and I don't like to bet against demographics. Right. So I think we've got a great tailwind. At some point that'll change, but we're going to have 17, 18% of the population that's 65 years of age or older, spending almost 40% of our healthcare dollars. And in our part of the world, that's only going to grow. So I like our odds, and I like the tailwinds that we've got. I think the best is yet to come.
I think so too. Thanks for coming on the show, Brandon. Appreciate it.
Thanks for having me, Matthew.